So this week on the markets, it's been a real reminder that investing is never boring for very long. We've seen AI stocks take an absolute nosedive. We've seen the announcement of the SpaceX IPO, and throw in the mix as well, oil prices climbing and creeping once again after an end to the ceasefire, and some funny little movements within various stocks related to, of course, the football Men's World Cup, which is about to kick off this week. So in this video, I'm going to be breaking down what everyday investors actually need to know from these headlines and what, if anything, you should be doing about these headlines. I'm Zoe and this is my channel, Words on Wealth. As a former wealth manager, I break down investing jargon, concepts and headlines to make you a more confident investor. Now I'm going to kick off today with talking about AI. It's kind of felt like that's what I've done for the last 3 years, but they have been pretty unstoppable when we look at the share prices of various different AI companies over that period. I'm talking the likes of Nvidia, Broadcom, AMD, there's so many more out there. And they've been pretty volatile, it's fair to say. Whilst generally the trend has been up, there have been bumps along the road. Last week was certainly a bump, or at least towards the end of it. We saw a major sell-off within various different tech-based companies and those that are particularly focused on semiconductors and AI. In fact, an index called the Philadelphia Semiconductor Index, which of course tracks kind of with a clue in the name, semiconductors, had its biggest drop since March 2020, wiping trillions of dollars off the value. And at market open today, we've seen Korea's market, which is made up of some strong semiconductor companies, also hit lows that have caused various different triggers to kick in and stop the trading. Now, there's a few reasons why this has happened. Firstly, Broadcom, that company I mentioned, released their earnings last week, and this is where they tell us how well they've done on a quarterly basis. And their earnings weren't quite as glowing as everyone was expecting. But this is kind of key. They weren't necessarily bad, they just weren't the perfection and the absolutely wild figures that we've gotten accustomed to seeing coming from semiconductor and AI companies. And as a result, that caused a bit of a wobble. Secondly, there is ongoing chatter, and this has been there for a while now, that AI is not quite living up to the hype that we're expecting. AKA, we're pumping loads of expectation within the form of valuations into their share prices, and actually they're now not really seeing quite what we were hoping for in terms of revenue generation and in terms of what AI actually can do to make things more efficient and better. A study released last week showed that Gen Z are pretty unhappy about AI, having believed that it could have made them more creative, it could have made things more efficient. Actually, what they particularly are seeing, for example, is just a real dearth in jobs, as AI is taking more of those entry-level roles. And then we've also started to see governments get involved. Donald Trump is a strong advocate and is still continuously pushing for more involvement and early access to AI, which indeed was something we saw last week. Meantime, on the other side of the ocean, we've got the EU releasing a tech sovereignty plan, aka they really want to make sure that they're protecting themselves, or at least still getting involved in the race in some way, but making sure it's not too dangerous and making sure they have control over it, and everyone doesn't quite know what they're doing. So amongst all this panic that I'm trying not to create, what does it actually mean for you as an investor and looking at this from a portfolio perspective? Well, really what it means is that volatility is a strong theme within the sector. We've seen it before, we'll likely see it again. So, whilst that panic is kicking in and I'm re-embodying it there, talking about it, but it's almost tongue-in-cheek and a bit of a joke, because actually it really is going to be here to stay. So even these wild swings may not mean the beginning of the end. It may just mean that you have to get used to that being a part of your portfolio. Because whilst AI has been a really strong growth trend, it can also show that even the biggest trends can be overheated. So still, even in good times, it's important to remain diversified and try wherever possible to keep exposure to other geographical areas, other sectors, and indeed other assets as well within your portfolio, because this will only help bolster if things do take a turn for the worst. The second thing that investors need to keep an eye on this last week and coming week is all about oil prices once again. Things had gone a little bit quiet on the oil price front as the prices had sort of deflated a little as the ceasefire had kicked in the Middle East, and things frankly had gone a little bit quiet. What that means is that those fears of inflation that had been stoked around climbing oil prices had also kind of hit the back burner for a few weeks. Actually, with the ceasefire over and various bits of data around inflation being released, it might not be quite as rosy as we're all thinking. Because oil prices do underpin everything. They underpin what businesses are spending, what you and I are spending, and not just when we're putting fuel in our cars, but also with relation to anything we're buying. Oil really is what society runs on and what economies run on. So if the prices go up, we'll see that iterated across the areas of the economy, spending, and our investing portfolios as well. A report last week showed that actually we're not expecting this oil price climb to be as bad as what we saw a few years ago when we saw the invasion of Ukraine. And that might well be the case. It could be that this is just a bit of a blip again, not necessarily as bad where we saw inflation hit, for example, at over 10% here in the UK, but actually just kind of manageable. However, take all that with a pinch of salt. We've got US inflation data coming up this week, and we've also got the ECB very likely hiking, that's the European Central Bank, hiking their interest rates. And this is all in inflation control. And it's rarely what investors want to see. It's no surprise, therefore, that actually we are seeing some slight changes within what we're calling safe haven assets. Traditionally, they've been the likes of US Treasury bonds and the US dollar. And in recent times, with this ongoing geopolitical uncertainty, a lot of it coming from the US and various different areas as well, we're seeing a shift towards the likes of gold as a different asset class. In fact, what we're seeing is that actually gold has become slightly more popular than US Treasuries, aka super short-term US bonds. So what does all this mean then for you and your investments? Because frankly, there's not loads that we can do about changing oil prices or indeed what's going on in the Middle East. But what it does mean is that we can keep an eye on our portfolios and make sure that that panic doesn't come across when we're thinking about what we do. Now, we can keep an eye on our portfolios and we can try wherever possible to make sure that we don't panic. It might mean that we need to keep some realistic expectations on our financial position if we do see inflation creep up and therefore potentially interest rates go back up once again. If, for example, you're in a position of looking at variable mortgages, if you're in a position of keeping high levels of cash and therefore dependent on the interest, then yes, those things may well shift slightly. But from an investing perspective, it just means that we need to keep an eye on this for the moment. On a slightly more lighthearted note, we've got the Men's Football World Cup kicking off this week. And therefore, what we've seen from an investing perspective is certain increases in various different sectors, companies and areas that are impacted by this major global tournament. I'm talking the likes of betting companies. I'm talking the likes of data analytics that focus specifically on sport. And, of course, I'm talking about the broadcasters that have got the exclusive rights to be able to show these matches that are viewed across the globe. Personally, I find these kind of movements really interesting. Not because they're necessarily something that we can jump on the back of or really go and try to seek out the winners, but rather because they show quite how emotional the stock market can still be. Whilst some movements within the stock market are tied clearly to deep economic movements that we can't influence or can't necessarily see or feel quite complicated, some of them are just as simple as everybody's watching football, and that football is coming from that one broadcaster, and as a result, their share price has gone up. Of course, football is here to stay, but the World Cup is a major tournament that's relatively short-term in its nature. Yes, there might be a share price boom in some of those companies over this brief period, but it'll likely come back down again when we all carry on to the summer, whatever else the football season has to bring, of course, as well, until the next 4 years when the next one comes along. Keeping in mind that long-term view as an investor can be really key when seeing some of these more panic-based and of course these more excitement-based headlines too, because actually keeping a focus on some of the longer-term trends, remaining well diversified as an investor and trying to avoid time out of the market just because your emotions got the better of you is kind of key to understanding what these headlines are all about. I think it'd be amiss to talk about the biggest three things on the markets that we're expecting from last week and this coming week without mentioning SpaceX. Of course, I did my Friday video on what that could mean, why you should invest, why not to invest, and also how it could impact overall indexes as well. So I won't go too much into it now, but it's certainly a major hype event. And I suspect there will be ripple impacts across the markets as well, as and when it happens later in the week. So there you have it, some of the biggest things that you can be watching out for on the markets and should really know about in hopefully a digestible way. So if you enjoyed this video, do make sure that you like and subscribe and let me know in comments which part of the markets you're following particularly closely at the moment. See you for the next one.